The actual mechanics of debits and credits is a very, very small part of the course. The predominant issues are theoretical and analytical. So that what you're going to find is that the background you're going to get with the course, as well as the way the textbook is structured, you have to know the mechanics. So I'm going to assume when we get to intermediate, and all the other professors in the upper level accounting courses are going to assume that the mechanics are second nature to you at that time. But what might not be second nature, and which we're going to start building now and we're going to reinforce as we go along, is the theoretical foundation. The theoretical foundation is absolutely critical because what will happen over time, you'll look at two competing theories, and what's accepted today may not be accepted somewhere down the road in your career. So I'll give you an example. You know, the intangible asset, goodwill. When I first started school, it was like, or college in the accounting curriculum, was like, wow, you know, goodwill is now going to be amortized. Isn't that something? And then all of a sudden, you know, 15, 20 years later, we no longer amortize goodwill. The theories to back that up were both presented, so I understood why we amortized goodwill or wrote off an intangible asset and why we did. So, and that's what you're going to need to establish. So if you don't establish the theory, it's going to be difficult to follow along as well. And then finally, it's analytical. And the way the course is presented, it's really from an analyst perspective or a user's perspective. So in other words, if you needed to build an automobile, I think the first thing you would want to know is how someone uses the automobile. Right? How does somebody drive? How do you build a car without knowing how someone drives? And that's exactly what we're going to be doing. We're going to be building accounting knowledge with the understanding as to how someone uses that information. How is it used to make decisions? How is it used internally and externally by the market, by individuals, by financial analysts, and we'll talk about that. That's what we're going to establish today. So, now, as far as the rest of the details are concerned, that's the textbook, and again, it's the 5th edition. 4th edition, I guess, is very similar, but the main thing is to get the My Business course, because that's where the homework is. The website has not been, I guess, 100% updated. It says 4th edition, but that doesn't matter because the problems are the same. Okay, so make sure you have that, otherwise you won't do the homework or be able to do it. That's the nature and purpose of the course, which I pretty much explained. These are your learning objectives. Let me just get through to the evaluation. So the way it'll work, well, I might give periodically as part of participation, maybe some minute quizzes or something like that, but predominantly your midterm and final are the key items. The graded assignments, that's the My Business course information that you have to finish, and then in class we have participation, and we're going to do lots of questions. Today is a bad day for you because you have a class right after this one. Normally you don't, but 4 hours is a long time. I will not teach 4 hours in the fall and the spring. We're going to do 2 and 2. We'll have a couple of breaks in between, and also the clicker questions. Those are ways for you to really sort of relax a little bit, answer the question, talk to somebody. I would even suggest standing up, because I could show you, I didn't bring it with me, but I have a photo of a brain that's been sitting for an extended period and there's no blood flow. When you stand up, blood starts to flow again. So it's tough enough to listen to accounting for 20 minutes, let alone for 4 hours. So I would ask you to use those clicker questions as a way to break loose. And if you want to, I could show you some films in my undergraduate class when I have 400 in a lecture hall. And once you start the clicker questions, it's like the level of noise goes way up. And that's a good thing because they're actually communicating and they're kind of breaking the monotony, I guess, of just sitting there. Okay, now the grades, this is a plus-minus system, so you could have a 94 average and wind up with an A-. Okay, so I just want to let you know that the graduate school uses a plus-minus system. Some departments do not. So for example, in finance, they only use the plus grades. They don't use the minus grades. So we're going to use the plus-minus grades here. As far as attendance, just make sure you read that. You may not think I'm taking attendance, but I do know who's here. And again, one of the things that I'm going to ask you to do is if you need to use a cell phone, let's say that's going to happen either from a family issue or especially next semester when the firms will be calling you and saying, hey, guess what? We want you to come in for a second round interview and you think that call is coming. You can kind of sit in the back, keep the phone down, and then you can just walk out and take the call. But I don't want you playing with phones. Normally I show you a picture of my grandson ignoring me with a cell phone, and I tell him, well, he can get away with that, but you can't, kind of thing. But he's pretty much hooked on it as well. I feel I don't have my phone on now, and I can actually feel my side buzzing. So we're all kind of hooked on this, and I understand that. It's a knee-jerk reaction. You'll see a light go off, something buzzing, and you're going to just go grab the phone. Try not to do that. I want to make sure you stay in the game, because only because it distracts you, because it distracts everybody else. Somebody sees you pick up the phone, and as I said, I know I've heard this 1,000 times before. Oh, I need to type my notes, and that's why my computer's open. And I'll walk around the room, and you're in international business, and somebody's watching, The Price is Right, or, just whatever you're doing is distracting. You definitely, or you have two screens, or, you split the screen. One is the notes from the class, and the other one is, soccer game or something. So that's why we ask you to keep those closed, okay? All right, and again, expectations, read that. I expect you to be prepared. Make sure you have the chapter prepared in advance. I think when we talk about, we'll see this throughout the curriculum, that when you look at the accounting standards, we're always going to have more than one alternative. I want to start building what we call professional skepticism. That means that you don't, at the end of the course, say that everybody in accounting is doing something unethical or illegal, but you've got to build a professional skepticism. You have to look at the accounting numbers with some idea that there's judgment or subjectivity that's built into those numbers. You can't take them at face value. If we had a set of rules that were standard across the board and you had no choices, then you don't have to worry, because everybody's using the same method and measuring them exactly the same way. The measurement systems change, and you have to remember that accounting is a measurement system, as we'll see. And I always give the analogy, especially this time of year, baseball season. So if you take a look at Yankee Stadium down the right field line, what is it, like 319 or 12 feet, you take that same distance and move it to Toronto, it'll be like 91 meters. Same distance, but measured differently. So you could take two sets of financial statements, somebody will report 312 for the same transaction, and somebody reports 91, depending on what measurement system they use. So a lot of what we're going to learn is how to decode those measurement systems, how to learn how to convert from the British system to the metric system, in a sense, and that's what happens. So you'll find out that there are different ways to measure the same transaction. All of us in the room right now could buy the same asset, get engaged in the same transaction, and have different results in our financial statements. And that's the most important issue to keep in mind, that there's different ways to interpret and different ways to measure financial transactions. And then the exams, closed book, will have both theory and practice. We'll talk about that. Makeup exams, obviously, if you have a very serious issue, I'll take that into account. Office hours are usually after this class, but you can always catch me at any point in time. I sometimes, if I find it useful, and it's pretty interesting because you can talk to the class from last year, I'm in the building all the time, nobody comes to see me. And then I'll say, hey, you know what, how about on Sunday morning if I want to go to a meeting? Everyone likes to do online office hours. I don't know why, but I could do that for you too if you like. So, but this will be a general time frame where I'll be here. I've got lots of meetings. I'll always meet with you separately if you want to. So just read that over. I'm on the 9th floor. A lot of you know that. A lot of you have been there already. And here's the outline. And I just want you to make sure you understand that we do jump around a little bit. So you've got the first 3 chapters. That's the critical mass of the debits and credits. Years ago, that used to be taught in like 2 or 3 weeks, an accounting cycle, and you would go right to intermediate. Now we have the entire course. We don't do chapter 5. We will move chapter 4 to the very end. The cash flow statement right here. Statement of cash flows is a capstone, and it's not the easiest topic, so I would hate to bring that in the 4th or 3rd or 4th week. So I want to make sure we we have that at the very end. And finally, when everybody gets their net ID, I'll be able to give you access to the academic integrity tutorial that the university requires that you complete. On every exam, you are asked to sign a statement that you see there. Okay. And what else can I tell you? All right. So, and any of this, make sure if you have anything you need, any special assistance, that you do that right away. What we don't want to have happen is that you don't get that approved. So some students, you might need extra time. You know, again, you don't have to tell me, but you just make sure you get to the office. There is a writing center. There's a learning center. And I think that's about it. Oh, okay. And here's your information for the course, which hopefully you all have the My Business course information, so you can do the homework. Okay, so I think that's about it. All right, now, before we do anything else, let me just move that over and get rid of the course outline. Does anybody have any questions on the course in general? Anything about the requirements? All the due dates are on My Business course, so you can see that. If anything happens, I'm very flexible. If you've got a good reason, I'll move things around. For example, you lost internet connection. The system didn't work. I would be more than happy to extend the deadlines on the homework. I'm more concerned that you do the assignment than not. So I want to make sure you get that done. So feel free to ask. Also, as you can see up here, I'll always try to start the class with some information for you. And there is a free accounting website, which is called, for information that you have, and that is called accountingtoday.com. And if you go on that, every day you will get news or reports about the accounting profession. And I would think it's probably a good idea, in particular, if you're interviewing, or right before you go to an interview, something may break. Now, obviously, you know the obvious things, that if a firm is getting sued, that's something you don't want to obviously bring up. But there's information. For example, I thought this was pretty interesting because in terms of technology and consulting, right now the Big Four, and this is an area that you may not know about, but the Big Four will have not only accounting, taxation, they have consulting, they have valuation services. So if you wanted to do business valuation, like investment bank kind of work, they do that as well. But this is an interesting move because this is after Sarbanes-Oxley and the PCAOB. At that time, the accounting firms had to shed their consulting units because of conflict of interest, and now the way they're structuring these consulting units, they're buying them up. So PwC just bought Booz Allen, which is a huge consulting firm, so that this article explains how the Big Four now are buying up these consulting firms as separate entities, and they're renaming them, but yet it's becoming a very large part of their business. And of course, conflict of interest, you wouldn't be the auditor if you were the consultant, but at the same time, it is generating quite a bit of revenue. So they become probably one of the top players in the consulting area. So I'll try to bring that up every week if I see anything. Also, if you have the Wall Street Journal, you can have that set for accounting or ethics information. I generally get a headline coming across my phone or iPad that is an article that you might want to share with your students, and you can do the same thing if you wish. All right, so that's it for the intro. So any questions on anything before we actually start? And you will get breaks. Don't worry, we'll do at least 2 breaks. All right. Now, let's go right into the material. And we're going to break this up by units or learning objectives. So the first thing we want to do, and today's going to be kind of soft in terms of material or qualitative information with respect to the users of financial accounting and, of course, the costs and benefits of providing disclosure. Now, there is a cost actually in higher level courses. You learn about the economics of information. How much should I provide and what's the cost? And we'll do a little bit of that right now. Okay, so first, let's take a look at what accounting is. And this is a definition, and I'm going to try to embellish this quite a bit if I can. But, according to the textbook, accounting is a process that summarizes and records and measures financial transactions. And I would rather say that it is an information system, and you will get information technology this afternoon, that measures and communicates financial information in order for users to make rational economic decisions. So one of the things that you have to think about when you think about accounting is that there's an information objective. And that's for financial accounting. Now, I don't know if you ever thought of this before, but what accounting really does is provides information that enables users to have enough information to make rational decisions that will direct capital flows to their most productive uses. So essentially, from a macroeconomic standpoint, you're going to find that accounting information, financial accounting information, will enable users to direct capital flows to their most productive uses. And what that means is that, maybe today, technology, solar technology, companies that are dealing with high level of technology might be the places where you would find most capital being directed. And of course, the decisions obviously have to take into account the risks and rewards of those investment decisions and, of course, credit decisions. And we'll find out that the investor and the creditor are primarily are primary users. Now, the next thing I want to tell you is maybe my opinion on this, but one of the things that I think you have to appreciate is that accounting is really a social science. So if any of you came here today thinking that the primary purpose of accounting is to put numbers in boxes, you're absolutely wrong. The actual numbers are probably the least important part of this. You need to understand that it's going to be this information objective. So when I say it's a social science, it means that it's not an exact science. It's not like math or maybe one of the other sciences. There's a lot of subjectivity that's involved. And it will measure and communicate this information to various user groups within the environment in which it operates. So a couple of key items here. We have this idea of financial information, which we'll have to differentiate a bit. We also have to think about the fact that it is a social science in nature. Accounting information that we're going to provide. And by the way, when we look at financial accounting, and we look at this as financial accounting information, what I want to make sure that we pick up now is that this is broader than the financial statements. You might think of, well, gee, I worked before and I used an income statement. Financial information goes beyond what you might find in those financial statements. All right, so as I said, the fact that it's a social science really should lead you to believe and understand that accounting is not an exact science. There's a great deal of subjectivity and judgment, so I'll make sure I highlight that for you. So when we say it's a social science, a great deal of subjectivity and judgment that's used in these financial statements. I'll show you that in a minute. And accounting standards will change over time. You know that there are local standards versus IFRS. And let me make sure we are clear that those are international accounting standards. We'll talk about that a little bit. Local standards are country by country. So the standards are different from one country to the next. They will vary over time. They change. And we try to standardize them as much as we can, and that's where the international accounting standards will come in. But I have a question. I have two questions here that I want to raise. The first one is, why do you think, why would GAAP or accounting standards be different from one country to the next?
Different rules and regulations in each country?
Yeah, or different, that's number one. So it could very well be, and I'm going to take that and just jump with it a little bit. It could very well be that the accounting standards are tied to some law. That's not the way it is in the United States. It's not the way it is in Great Britain. Some countries, for example, particularly continental Europe, will have accounting standards that are tied to tax law. That's not the case in the United States. But there is SEC regulation. So the SEC will regulate. Where in Germany, for example, their standards may be a little bit different because of their government regulation. So that's one important point. There's also different types of financial markets, and let me use Germany as an example. Again, in the United States, we predominantly rely on what type of capital? Debt or equity? What would you think? Stock? Or do we borrow more, or do we issue more equity? What are the stronger markets? And again, I know a lot of you might not. Or what's the bigger player in the United States?
Borrow. Equity?
Equity, yeah. It's pretty much an equity-based economy. We do borrow, and we'll talk about debt-equity ratios, and you'll see it varies by firm. In fact, Apple just started borrowing maybe about 5-6 years ago after the recession. And why? They didn't need it. It was just cheap. Interest rates were low, so they might as well borrow. Very high-tech startup companies tend not to borrow, and they go to the equity markets. And they tend not to pay dividends either, when they first start up. So they've got lots of cash. So, Apple just started to borrow recently, and they're doing that because it's cheap. It's just cheap debt, But we predominantly will work on a equity-based market. So our statements in the United States are more geared to a stockholder investment than it would be a debt investment. Now that changed. One of the things that's interesting historically, if you look at United States financial reporting, we started where we focused on debt financing because years ago that was our main concern, is financing through the debt markets. And in Germany, yes, they have a well-developed stock market, but they borrow a lot more than we do. And in Germany, the bankers could be on the board of directors of these companies. So that means that disclosure doesn't have to be as much as it is in the United States. So country to country, different economic systems, different legal systems will drive different accounting standards. Now, if you look at the second bullet there, it says that we've got different accounting methods that will change over time. There's a great deal of judgment, subjectivity, estimation, and the accounting choices we have. And this is something that you'll be looking at for the rest of your accounting careers, is that there's always two ways to measure. Again, let's talk about 91 meters versus 312 feet. Let's just say hypothetically that was roughly the same distance. Two ways to measure exactly the same event. One is higher than the other. And in accounting, we have income increasing. Oops, this doesn't work. So we have income increasing and income reducing accounting alternatives. Okay. Again, different firms, different industries will have different packages. They'll have a package of an income increasing set of standards. That's what they'll use. Others will use income reducing standards. Why? Which one would you use, by the way? What do you think, what would you do if you were managing a company? Which one and why? What do you think? I'm just trying to raise some, yeah.
Maybe increasing because it looks good for the investors?
Yeah, so, and we're gonna build on this as we go along, but an income increasing alternative, get more investors, attract more capital. And again, we wanna make sure that you, by the time you leave here, and financial analysts obviously know how to read that and get to the real, that's why we do the cash flow last, because cash flow is the equalizer. No matter what accounting method you use, you can't play with cash flow. I mean, it's either there or it's not. And we'll talk about that, and we'll talk about why we don't use a cash basis. So you might want to have higher earnings for investors, for creditors. What else? Yeah, Amanda?
Probably want to use the income increasing unless the income reducing drastically reduces costs.
We get back to what's that?
I guess the only reason we want to use income reducing is if it reduced costs through the extent that profit increase.
Yeah, okay, so an income reducing, there are some costs that could reduce. I'll explain that in a minute. Anything else on the increasing side, though? I mean, there's got to be more reasons than just, what could you think? What if your bonus as a manager was tied to accounting earnings? Right? Or here's another question for you. Do you sell more products if you're more profitable? Yeah. I mean, look at General Motors during the recession. Would you buy a GM car when you weren't sure if they would be in business in the next year? So profitability, I mean, listen, I'm pretty much hooked on Mac, regardless, so you can't use it for 90% of the software these days. But I just think it's a kind of an aura. It's profitable. The company's like huge. It's got a tremendous market capitalization. It's the wealthiest company. So I'll pay more for an Apple laptop than a Dell. And it does the same thing. Right? So it's really, you're going to sell more. And you got the backup of the company. The company's profitable, they'll back up. And that's how consumers, we'll go through the litany of this list of how companies, or who uses the company's financials. But income increasing will definitely help you there. All right, now, income reducing. And by the way, an income increasing standard could also reduce the cost of borrowing as well, right? Because, if you're more profitable, they might give you a better credit deal. Income reducing, so you said it could reduce some costs. Why would you want to show lower income?
Less taxes?
Okay, that's a great answer because it's got a lot of meat to it. Taxes. First of all, let me tell you that is indirectly, it's true, but on an indirect basis. Because directly, we've got two sets of standards. Let me use the dot cam for this. So we have two sets of standards. We've got, I'm going to make this a little larger for you in a second. Okay. We've got GAAP, generally accepted accounting principles for financial reporting. And you have tax. And these are not always the same. So you've got different standards for tax than you do for GAAP. They're similar, but they're different. They're not 100% the same. Now, Greg, why I said indirectly, because sometimes the government will look at your financial reports to say, hey, wait a minute. These guys are not paying us enough tax. They did that with the oil and gas companies. They're saying, oil and gas companies are making a fortune. Why aren't they paying us more tax? So the government went back, Congress went back, and they imposed what was called an excess profits tax, an indirect way. So that's why we were saying if you had lower profit, you could avoid those political costs. And what I mean by political cost is not only the government getting involved, but also, what about the public? You know, gas prices go up to $7 a gallon, and the first thing you hear on the financial news is that Exxon and Mobil and Shell report excess profits or record profits, right? So again, politically, oil and gas companies tend to show lower income. Microsoft, for years, was showing lower income because of what? Monopoly, right? The government would have thought that Microsoft was dominating the marketplace. So you could show lower income and maybe look a little bit smaller to the external reader. So there are reasons but for the income reducing. But getting back to the tax, why do we have different rules, do you think? Why not use, and by the way, in some countries, they do. So in the United States, one of the things that you will grapple with next spring in Intermediate 2 is accounting for income taxes. Not income tax accounting, but how do we account for income taxes? And that's because in the United States, the US, UK, Canada, Australia has a model where our financial statements are radically different than our tax returns. Because we have our own set of GAAP standards for financial reporting and our own set of tax rules for tax reporting. Why are they different? I can tell you continental Europe and Italy, Switzerland, Germany, there were very few book tax differences, very few GAAP tax differences. 90% of the financial statements tied back to Japan, the same thing. 90% of those statements tied back to the financial statements. Why are our financial statements so radically different from the tax return?
Because you want investors to have more specific information than you want the IRS to have?
Yeah, well really, if you go back to one of the first things I said this morning, the information objective. The tax returns are not built to gather information to use to make investment decisions. They're used for what purposes? Why does the IRS have tax rules? What are they trying to accomplish? What are the objectives for tax? Anyone know?
You want to generate more revenue?
Yeah, pretty simple, right? They want tax rules are designed to raise revenue. All right, so that's number one. They have economic objectives and social objectives. All right, so think about raise revenues, that's a pretty easy one. What about economic objectives? Every country in the world has enterprise zones. What's an enterprise zone? Well, start a business in Newark and New Jersey will charge you less tax. I don't know if you I know a lot of you may not have been in New York, I think it was up to like last year. New York State, if you opened up a manufacturing facility in New York State, you did not pay tax for 10 years. 10 years, right? Obviously, they're trying to stimulate the economy and maybe even regentrify certain areas of the state, and that's a social objective as well. So tax law has different objectives. As far as we're concerned, we only have one purpose for financial reporting, and that's an information objective. Different objectives means what? Different standards. Different objectives means that you'll have different accounting rules. So to achieve certain objectives for tax purposes, you have to account for transactions differently. To achieve an information objective for accounting purposes, you have to, again, deal with a different set of standards. So the standards are different in order to meet the different objectives of the two reporting, or the two regulatory, if you like, groups. Okay, so for tax law, you want to raise revenue, achieve certain economic, and achieve certain social objectives. Accounting, for us, since we're taught, we'll go back to managerial accounting and a bit later, but for us, for external reporting, and that's going to be our specialty here, intermediate 1, intermediate 2, advanced. It's external reporting, provide information to make those decisions. All right, does anyone have any comments or questions on that? I know it's a lot of these things you probably didn't think of before, and something you have to start, in broadening your view of accounting. Yeah.
I just had a question about, you said we're an equity economy versus debt economy. You mean more individual companies, not like the US as a whole, which has a lot of debt? Right?
Yeah, that's right, no. We're saying from the standpoint of financing a business, you would generally, if you started a business right now, and the textbook even brings that up, the first thing you do is you have a small business, and then you look for investors. And you could borrow first, but again, once you have that debt, the problem is debt has to be paid back, and interest has to be paid on the debt. So a startup company like Apple would have in its infancy had zero debt, and they just borrowed, as I said, about maybe 6 to 8 years ago was the first time they borrowed. So generally, if you look at a company's life cycle, and you'll probably pick that up in management or one of our other courses, you'll see a startup company has no debt, doesn't pay any dividends. When the company starts to mature, and Apple is getting to be a mature company, and they'll start borrowing more and they do pay dividends now. So yeah, in general, but not, specifically, but not the economy as a whole. Okay, good question. All right, any other questions or points on this? And we're going to spend some time on IFRS, particularly in our intermediate courses. There aren't that many differences between US GAAP and IFRS here, but we'll see some. All right, so any other questions? All right, so let's take a look at this definition of accounting again. So let's look at the environment. That's another one that, and we'll get to the user groups in a second. All right, so the accounting environment is really made up of external forces. And these forces are political, social, economic, legal, consumer-based, competition, pretty much a lot of the things we talked about before. And you have to think about accounting as it is both reactive and proactive in its relationship with its environment. Accounting will react to pressure from various groups. So, for example, the government could put pressure on accounting. And we'll see this in a bit, what you might have picked up from the text, but if not, the Securities and Exchange Commission and the US government has the absolute authority to dictate accounting in the United States. But they decided to let the private sector handle that, and we do that as a profession. But they can come in and put pressure on us at any point in time. The government has stepped in and has, at points in time, said that the accounting standards that we're using were not adequate, and every once in a while they'll put pressure. Legal, social, economic, the economy. Economy is bad. Bad economy, 2008. What do? We changed some accounting rules to try to help companies get through the recession by helping them, for example. What did you do? A lot of you had these toxic mortgages, right? You had all these mortgages on bank balance sheets. Oh, they weren't anything. Should they be written down to zero? And under certain accounting principles, they should have been, but the accounting standards were changed to help them. And for example, they said, well, if you expect over the long run to ultimately collect it, you don't have to write it down. All right, now, do I buy that? Well, no, but did it help these companies? Yeah. Because if banks, the bleeding would have not stopped as quickly as it did if these companies were forced to start getting those receivables that other people owed them and started just mercilessly writing them off to zero. It would have decimated balance sheets of a lot of these financial institutions. So the accounting standards, and this, by the way, started in Europe with the IFRS, they push back a little bit on how you would start writing down or writing off these receivables. So economically, that will happen as well. Accounting is proactive because they do provide standards. It's feedback information to the market. But here's the real way that they're proactive. They will actually change the way that managers operate. They will change the way, an accounting standard will change the way accounting managers in companies will make decisions. So for example, and we'll see this throughout the semester, but when a company like Johnson & Johnson invests in research and development, is that an asset to the company? What do you think? Research and development. It's an asset, but we treat it as an expense now. And that was an argument that accounting standard setters had a problem with. That, you know what, if you did research, the future of that research is unknown. And therefore, we're going to expense it. Now, anytime Johnson & Johnson spends money or Apple spends money on research, it affects their bottom line. It reduces their profit. And, years ago, it used to be an asset. It used to be an investment. So what argument do we make? Well, by changing, for example, by changing the accounting standards, a lot of people argued, well, now that you're affecting my bottom line and research is somewhat discretionary, I may hold back on doing some research because it's discretionary. So instead of spending $80 billion, I might spend $60 billion this year because I want my profit to be a little higher, or I want to meet analyst expectations. So by changing the way we account for research, it may in fact affect the way managers decide to invest in research. It's not, it's not a proven, but it may be something that you would think about. Employee options. If I pay you on a stock option, let's say today I say, you know what, I'm not going to give you a salary. I'm going to give you the ability to buy one share of stock for $100. The market price of the stock right now is $100. How much did I pay you? You're going to buy the stock at $100, and it's worth $100. Nothing. And that's the way we used to think about it. So these options used to go unrecorded. But now they said, well, you could measure the options because who would work for nothing? This makes no sense, right? I mean, you wouldn't work for nothing, so I'm not going to, allow this to continue. So accountants decided that they would find a model, a way to measure the value of that salary. And now all of a sudden, those options hit the bottom line of companies. What happened to stock options? They're used a lot less now. And management has found other ways to compensate. So accounting is proactive because the bottom line here is a lot of you may not know these specific examples, and that's perfectly fine right now. But the point is that accounting standards will be affecting the bottom line of companies, and that will affect the way managers make decisions. And that's the bottom line for me on this comment. All right, so that's the overview. Does anyone have any questions on the overview of what accounting is? Again, social science, it works throughout the environment. It's going to be affected by the government. It's going to be affected by legal changes. It'll be affected by consumer demands. It will also be proactive. It will affect the flow of capital throughout the economy because profit will drive investment, and investment will drive technology and innovation. It'll also, we'll get to the user groups in a second, but it will also satisfy, overall, it's going to satisfy a user objective of information. That's the key. So any questions at all, or any comments at all on the overview? All right. Now, two categories of accounting, financial and managerial. Managerial accounting is what you'd see in cost accounting. And both of them, obviously, we'll talk about these user groups now that make up the environment. So this is going to be our primary focus, and that's going to be financial accounting. And again, that's designed to provide information to decision makers outside of the company. And we're going to be, unfortunately, strapped with regulation. We're going to be, our reporting and our measurement systems are regulated by the Financial Accounting Standards Board, by the SEC. These reports have to be general purpose reports. We can't make them specific. So if I was a stockholder or if I'm buying another company, so AT&T buys DirecTV, during that merger, we can't say to AT&T, gee, I wish I had something else on your audited statements. They could demand information internally, but they can't ask the auditors to provide them with specific information. So we are bound by certain rules, restricted by GAAP, restricted by regulation. Now, in the spring, when you take managerial accounting, here, internal decision makers, primarily designed for internal decision makers, we could have special purpose reports. We don't have any GAAP. We can use forecasts. We can use different models. It is used for decision making. This information is not externally disseminated, and therefore it does not have to follow any specific government regulations. So it is more likely to be based on projections, forecast, budgets, whereas we are really not permitted to use forecasted information in financial accounting. And then finally, we'll summarize this, but this is what the demand for information looks like. I mean, obviously, you have these user groups, you have multiple user groups. And the multiple user groups, that's what causes us, so since we have so many user groups, that's why we issue what are known as general purpose financial statements. The general purpose financial statements are designed to best satisfy all of these users simultaneously. But the primary users are the investors and creditors. So even though they're general purpose, in other words, they're not designed for any one of those groups individually. But the primary users would be the current shareholders and the creditors. Investors and creditors are viewed as our primary users of financial statements. And then, of course, we know that, for example, financial analysts will use this information, government agencies. Government agencies, by the way, as we said, and Fred asked a question or mentioned the question before, would probably be, the SEC, and even the IRS will use that in an excess profits tax kind of scenario. You also have potential shareholders and creditors, sometimes management, as I said, to make decisions on bonuses for external information. Customers, we already talked about that, where consumers would obviously be looking at information about companies to determine whether to buy products from these companies based on their profitability. I'm not saying you pick up their annual report, but you hear enough about a company's profitability or their lack of profitability, and that could drive your decision whether or not to buy that company's product. Suppliers as well. I mean, suppliers, before you enter into a long-term supply agreement with anybody, you're going to look at their financials. Obviously, if they do not have the ability to pay you back, you're not going to sell them any product. Now, of course, the rest of this I think is pretty simple. I mean, the way this would just summarize who makes the decisions. Obviously, what decisions are made. So, for example, internally, you look at strategies, you look at new products, how to manage operations. Obviously, for a outside or an external investor, whether or not to buy or sell the stock, whether or not to extend credit. And then the information, obviously, that we're going to provide you. Budgets I mentioned internally, but the information that we're going to provide you in financial accounting, sales, revenues and expenses, cash flow, and then assets and liabilities. And we're going to look at the statements. These are the statements that we probably will be driving throughout the rest of this few chapters. Sales and costs, we've got the income statement, cash flow statement, and then the balance sheet. And we'll see that as we move along. Okay. All right, and again, the multiple user groups, as I said, make sure you're very clear that obviously the internal users can look at special purpose reports, but we're of course going to deal with the external user, and that's why I said we've got these general purpose financial statements. All right, so now, the type of business is going to play a role. A lot of you should be familiar with this, and I know that you may have seen this a couple of times in different places, but the primary type of business that we'll be looking at in this course is going to be a corporation. You know, or you should know, that the corporation is a separate legal entity, and obviously a lot of information is required because of the separation of owners and management. With widespread external users, you need a lot more information. Right? There's a large separation between the owner and the manager. Now, this is a separate legal entity, and it's a separate accounting entity. Now, this is going to become important when we look at some of the theory. The sole proprietor, of course, is one individual. We don't deal with sole proprietors here, but the sole proprietor is not a legal entity, and the same thing is true with a partnership. Partnerships we'll take a look at. That's where two or more individuals are grouped together to form a business, obviously with the objective of earning a profit. But the two things that are important here, or really the most important issue, is that the sole proprietor and the partnership are not separate legal entities. So that when you look at the types of businesses, and we will do partnerships in advanced accounting, so that the corporation so the sole proprietor and partnership will be different, because the corporation is a legal entity and an accounting entity. Or an economic entity. So as far as a corporation is concerned, it's a separate legal entity. It could buy and sell property in its own name. It could borrow in its own name. Whereas a sole proprietor is not, and a partnership is not, a separate legal entity. So when you start looking at taxation, if you have your own business, so for example, I had my own, I wasn't incorporated, I did a lot of consulting. That gets combined with my individual tax return. I don't have a separate business. I'm taxed once as an individual. I'm not taxed twice. Obviously here, I would have been taxed twice. I would have been taxed once as a corporation and once as a shareholder, pulling those dividends out. So when you look at a sole proprietor, it's a single entity. And the same thing's true with a partnership. It's not a separate legal entity. So a lot of you will be working, and that's why we cover partnerships first thing in advanced accounting. A lot of you will be working in hedge funds. Hedge funds are built as partnerships, and they are not taxed. So if you work for Apollo Capital, or my son is a, I don't know what he is there, a CFO or something of one of these hedge funds, he basically is preparing financial statements, but those financial statements are not necessarily going to be, or the tax returns, I should say, are not going to be used for taxation. All they're used for is to provide information to the individual partners how much tax they have to pay. So the partnership does not pay an individual tax. The partners pay the tax. So the business, the partnership itself, does not pay the tax. That's because they're not separate. So when you start dealing with partnership taxation, the work is getting the information together. It's an information return, but then the partners pay the individual tax. It's not, this proposal, by the way, to tax partnerships as businesses, as a separate entity, but right now that didn't happen. So the problem is they're not legal entities, but they are accounting entities. So we have to treat partnerships and sole proprietors as separate entities, and we do that by assumption. We assume that they're separate. So here's the trick. What do you do if you understand that Mark Zuckerberg buys 2 vehicles? Facebook records it? Depends. If Facebook is going to use those cars for business purposes, then of course they go on the financials. If not, it's a personal transaction that we keep separate. So that the bigger problem here is when you have partnership and sole proprietorship is not only the legal issues, which we'll talk about briefly, but again, there are problems in deciding sometimes about those transactions. So transactions that are conducted by the partnership and the sole proprietor have to be looked at very carefully. So for example, I'm doing consulting, I renovate my basement where my office is, hypothetically. Do I deduct that on my taxes? Was it a personal transaction? Was it a business transaction? You know, if it's personal, I can't deduct it. If it's business, I can. But it's on one single tax return. And those are the kinds of decisions we have to make when we look at accounting transactions. Although we won't see sole proprietors all that much, and partnerships we'll see in advanced accounting, but you have to keep the economic substance separate from the legal form. So to summarize, a sole proprietor or proprietorship, again, is not a separate legal entity, and you'll see a lot of this in business law, has a limited life, so it pretty much will last as long as the life of the owner, and it has unlimited liability for the personal debt. So if I have my own business and I'm a sole proprietor, that's it. I mean, you are liable for all of the debt up to the personal assets. Your personal assets are at risk here, and then we have to make an economic entity assumption. So the economic substance over the legal form of that business. For a general partnership, again, it's not a separate entity, and of course, it has a limited life. By the way, I don't know if you'll see this in advanced accounting. It's pretty odd, and I know that the big 4 public accounting firms have this worked out pretty well, but if one partner leaves, the partnership terminates legally. And when a new partner comes in, the old partnership terminates. So the life of a partnership is very fragile. And you have unlimited liability for the debts of the business. And the disadvantage, as I said, is even worse if you think about mutual agency. So if you and I are partners, I hold myself out as a partner of our firm, I have the right to bind the firm into legal contracts. That's known as mutual agency. So if I make a mistake, we're all in trouble. Mutual agency is a good thing in the sense that I can conduct business for the partnership. It's a bad thing if I make a mistake, because then you're roped in as well. Right? It's a mutual agency, so that we're liable unlimitedly for those transactions. Whereas a corporation, and by the way, general partnership also is going to be a separate legal entity, of course. A separate accounting entity, and it is economic substance over legal form. Now, there are some limited liability partnerships, which protect personal assets to a certain degree, and that's covered in other courses. Okay, now, the corporation, as we said, is both a separate legal and a separate accounting entity. It is, in fact, going to be a separate legal person. It has an indefinite life. You are limited in your liability. You're only liable for your original investment. So if you invested $10,000 in stock, company goes bankrupt or gets sued, the most you can lose is your initial investment. And the economic entity assumption here is not really required because, again, it is a separate legal entity. So we are going to, and the main thing for us is to keep the stockholders separate from the corporation, to keep the owner separate from the sole proprietor, to keep the partner's business separate from the partnership. So we do this through the economic entity assumption, although it's not really needed for a corporation. A corporation is already a legal entity. So you don't have to worry about, in a sense, making that assumption. All right, and then finally, just one or two other points here. In terms of the users. So we know that in corporations, we already talked about this, that stockholders will provide the capital not involved in the day-to-day operations of the business, and that's why when we look at the information objective, again, we are going to focus on the corporation. So when we focus on the corporate form of business, this is what drives the type of accounting we have in the United States. It is information-based. We have to get information out in a transparent way to the stockholders because they're not involved with the day-to-day operations of the business. So, for example, going back to Germany, if the German companies rely more on debt financing, and this is not legal in the United States, but in Germany, on the board of directors, bankers could serve. So you could have your main creditors sitting on your board of directors. They can get inside information anytime they want, so the level of disclosure in continental Europe is a lot less than the disclosures we have in the United States. One of the things that you'll find out when you start looking at financial statements is that the disclosures are extremely voluminous in a U.S. financial statement. If you look at a 10K, some of you worked before, right? You've seen a 10K. 10K could be extremely large in terms of the disclosures that we provide. So those disclosures are required for transparency for the stockholders to evaluate performance, to predict, to assess the company's financial condition. And as we already said, we know that the growth of corporations, and we talked about this already, we mentioned this, that you would probably, when you first expand or when you first start your business, you'd probably go out to the equity markets. All right, so now let's, and then eventually borrow. Okay. Now, let's go through, once again, the users. I know we said this already, but let me just summarize now. We talked about the external use of financial statements. Just to be sure, creditors will obviously be looking at the financials to be sure that you could repay principal and interest. Suppliers, they'll provide you with inventory or services before they sign a long-term contract with you. They would make sure that they would review your financial statements thoroughly. That would allow them to have confidence that you would have the ability to repay the debt or to repay the payables. We know that obviously management would look at the financial statements of a company to determine their bonuses or their performance. By the way, if you start, right now you don't have access to public accounting firms' financials, right? They're partnerships. You can't get their financial statements. But if you've ever done this, I've done this once or twice, where looking at a company as a potential employer, I think the first thing you do when you look up the company is look at their annual report and just look at the businesses they're in, look at the scope of their operations, and then even look at their profitability and what their strategic plan is And that's important for management, whether they're in that company or looking to change jobs. I mean, you've got obviously a need to understand the profitability of the company. Board of directors, of course, will use this to assess management performance. They review the financial results to evaluate the company's performance and its strategy. Okay, so these are the users. Again, in summary, prospective employees, as I just said, would be examples. Labor unions. Why would labor unions need to look at financial statements? That's one that we left off. Yeah. Right.
So they can have a better negotiating position for contracts or
Yep.
increases?
Yeah. And that's something that I was going to wait to mention. Income reducing standards. If you show less profit, you may be able to justify a lower increase in wages. One of the first times I was teaching, someone spotted, we were doing a inventory, and I showed them this method that reduces income significantly. And this person, oh yeah, we just adopted that method. That's why my profit sharing was so low. So if you wanted to reduce profit sharing, you could just adopt an income reducing standard. I mean, that's a way to do it. And you're right, labor unions will look at financial statements for those purposes. Government agencies, insurance companies, I mean, you got a wide array of using that information. Okay, so we've already discussed that. And disclosure, providing information, we already talked about the benefits. It may lower costs through getting better borrowing rates if you show higher profit. It could lower costs through better relationship with suppliers. Obviously, we mentioned that an income increasing standard could in fact help you raise capital at lower rates. You could also have income reducing standards, which might make you less visible in the public, less public criticism. You may also have less government interference if the company is small. So those are some of the benefits. Now, the cost. There is a cost of providing accounting information. And this is something that comes up quite a bit when we change accounting standards. Anytime you change accounting standards, one of the arguments that companies make against the standard setting board is that, hey, now what? It's going to cost us money to change our accounting systems, right? Because you have to change, if you change the accounting method, you have to train people, you got to change their accounting system, so it's expensive. There's a cost of changing. Also competitors, and this is very interesting because I'm writing a paper with someone in Germany, and that's why I keep mentioning some of their standards. They have, when we have disclosures on contingencies or disclosures on transactions, our disclosures are much more significant. Theirs are a little bit less transparent. And the reason for that is competition. I mean, if we asked companies to disclose every detail about their upcoming strategies or contingencies or potential losses, that could give a competitor an advantage. So you have to balance out the benefits of disclosure with the costs. And finally, of course, we mentioned regulation. And that's why we talked about this before. Remember, profit could drive regulation, monopoly, concentration. I worked at the Federal Trade Commission for a while, and I know that they keep track of market concentration. What are your sales? For example, they did not permit the merger of the Dish Network with DirecTV. And there was another merger they just squashed a couple of months ago because of unfair competition. So again, size of companies, market share will be looked at carefully. And how they measure market share? By sales, by profit level, and of course increased taxes. Now, remember, that's why I'm glad when Fred answered the question. When we talk about taxes here, remember, it is not on the tax return itself that we're talking about. Two separate books. By the way, you've got, you've heard the, the term two sets of books. Well, it's really multiple It's really multiple sets of books. You've got one set of books for your stockholders. You got federal tax, foreign tax, state taxes, which could have different sets of numbers. So let's just take GAAP, general accepted accounting principles. We'll define this later. That's our financial accounting. So we have one set of information here, and then we have tax information. Now, we're not saying in our courses, unless you take the tax course, we're not saying that increased taxes are imposed because of what they see on the tax return. I'm saying that they do look at your financial statements. And again, they're going to say, hey, wait a minute, you report, and by the way, look at your own tax return. What's your gross income? Let's say you have a gross income of $50,000. What's your taxable income? Taxable is 35. All right? What are those deductions you're taking? You know, we're going to go back and we're going to take a look. I don't know if you know, have any of you heard about this alternative minimum tax at all? Yeah, it's a pretty interesting law. And for an individual, the way it might work is as follows. You invest in tax-free bonds. Now, you don't have to pay tax on it. However, we're going to look at, let's just say the interest, the tax-free interest is tax-free interest is $15,000, right? So that's how we get from the 50 to the 35. The way the alternative minimum tax works is the government says, well, you know what? You guys are really taking a lot of advantage of the tax law. I mean, you could invest in tax-free bonds, but that's kind of a lot. So what I'm going to do, let me just see what's the most taxed. I'm going to add this back and tax you at a flat rate of 20%. And if that's higher than your regular tax, you'll pay the higher of the two. So essentially what they'll do is look at what you're doing from a financial accounting standpoint and reassess your tax based on the tax advantage you're taking. Now for corporations, they do that for accelerated depreciation. You take a lot of depreciation on your assets, a little too much. I think we'll go back and reassess you. So they will look at your financial statements. And for the oil and gas companies, what they did, and by the way, this happened in, I think, President Carter's administration, and I believe that President Bush and President Obama were also considering this, an excess profits tax on oil and gas companies, excess profits tax. They look at your financial statements and say, this is extremely high relative to the taxes you're paying. And therefore, we're going to assess additional tax on what we call the excess profits tax. So the bottom line, to make it very simple, the government will look at your financial statements to determine whether or not they should adjust tax law. And that's where the political costs come in of showing higher profits, Okay, so again, it's a separate set of information, and we're just going to focus here. We're not going to worry about the tax return right now. And then when we do tax accounting, we're going to look at the effect of taxation on the financials, but we're not going to do any tax returns. Any questions on that? I mean, it's kind of important to look at the economics of information. You have to find the equilibrium. You know, how much information do you provide before you start getting increased taxes, before you start having competition going in the wrong direction for you, or at least providing too much information for the competition. Yep.
What advantages, since you're talking
I'm
about
coming
Germany,
back. Yep.
what advantages in Germany, or their system that they have in place, what are the advantages for Germany to stay that way?
Because again, they have less reliance on the equity markets, and as a result, if you've got a relationship with your bankers, the bankers are on your board of directors, so therefore you've got less of a need for extensive disclosure. See, we have more of a reliance on the external equity markets, and we need to provide much more disclosure. And the issue, of course, is when a German company trades on the US stock exchange, how much more information do they provide, or do they provide more information? And right now, we do accept IFRS statements on our US stock exchanges. And one of the things that you should know is that you will never know when you're going to be looking at IFRS statements. So we do have to cover that in some detail in the intermediate. Because I was just doing some, the school was doing, as a relationship with BASF, right, where the Jets practice in Florham Park. It's right up the street there on Jets Drive. And I was in there, and that's all they use is IFRS, even though they have to report in the US. So, those standards are a little bit different. In some cases, a lot different, as we'll say. All right. Now, I should have mentioned also that, to answer another part of your question, is that it depends on the local economic environment. So let's just say in Switzerland, we can raise capital by issuing statements that are based on tax law. I mean, it seems to work, whereas in the United States it does not. And in the UK it does not. So in the US-UK model, it's financial accounting, one set of rules, tax, another set of rules. In other countries, these rules are much more similar than they are in the United States. And it depends on what the economy needs to drive its capital flows. If the tax return information is sufficient, then that's going to be what you would get in those statements. Here, it seems that we need to do more beyond, or go way beyond, what we need to provide for taxation. Okay, good question. Any other questions on cost and benefits of disclosure?